Your mortgage is up for renewal. Don't just sign what the bank sends you. If your mortgage is coming up for renewal, your bank will probably make the process look incredibly simple. They'll send you a renewal offer, give you a few interest rate options, and tell you where to sign. And that convenience can be expensive. Mortgage renewal is one of the few times when you have a real opportunity to renegotiate a major part of your finances. So before you automatically accept whatever your current lender sends you, there are a few things you should look at. First, let's talk about what actually happens when your mortgage renews. In Canada, your mortgage term and your amortization are two different things. Your amortization is the total amount of time you expect it to take to pay off your mortgage. That might originally be 25 years. Your mortgage term is the period covered by your current mortgage agreement. A common term is 5 years. So when that 5-year term ends, you haven't necessarily paid off your mortgage. You still have a remaining balance, and you need a new mortgage term for that balance. Your existing lender will normally send you a renewal offer before the term expires. But here's the important part. You don't necessarily have to accept it. You can negotiate with your existing lender, or you can see what competing lenders are willing to offer. And even a relatively small difference in your interest rate can matter when it's being charged against a mortgage balance of hundreds of thousands of dollars. Let's say your bank sends you a renewal offer. Before signing it, find out what other competitive rates and mortgage options are available to you. Then go back to your existing lender and negotiate. You can tell them you're considering moving the mortgage and ask whether they can improve the rate or terms they're offering. Your bank wants to keep your business, but they don't necessarily have a reason to give you their strongest offer immediately if you're willing to accept the first one. And if they won't compete, switching lenders may be worth considering. However, switching isn't always as simple as comparing two interest rates. Depending on the mortgage and the lenders involved, there could be appraisal, legal, discharge, registration, or other costs. A new lender may cover some of those expenses, but don't assume that they will. Compare the entire offer, not just the advertised rate. The next major decision is whether you want a fixed or variable mortgage. With a fixed-rate mortgage, your interest rate is generally locked in for the term. That gives you predictability. You know what rate you're paying, and depending on the mortgage structure, you can have predictable payments throughout the term. A variable-rate mortgage moves with changes in the lender's prime rate. That means your borrowing costs can rise or fall. Variable rates can be attractive when rates decline, but they also expose you to the possibility of rates moving higher. There isn't one answer that's right for everybody. Ask yourself a practical question. If rates increased, could your household comfortably absorb the higher cost? If the answer is no, the certainty of a fixed rate may be valuable. If you have more financial flexibility and you're comfortable accepting interest rate risk, you may be more willing to consider variable. Renewal is also a good time to look at your remaining amortization. Imagine you originally took out a 25-year mortgage and you've now paid it for several years. If you can afford higher payments, shortening the remaining amortization could help you become mortgage-free sooner and reduce the total interest you pay. But be careful about moving in the opposite direction. Extending the amortization can reduce your required payment, which may provide some breathing room in your monthly budget. The trade-off is that you're usually paying the mortgage for longer and potentially paying substantially more interest over time. A smaller monthly payment doesn't automatically mean a cheaper mortgage. That's why you should look at the total cost, not just the payment. Renewal is also a good time to review your prepayment privileges. Can you increase your regular payment? Can you make lump sum payments without a penalty? And if your financial situation improves, how quickly can you attack the principal? These features can be extremely valuable if your goal is to pay your mortgage down faster. Finally, don't wait until the last minute to start looking at your options. Give yourself enough time before renewal to research rates, contact your lender, speak with a mortgage broker if you choose, and compare competing offers. The objective isn't necessarily to switch lenders. The objective is to make your current lender compete for your business. If they come back with the best overall offer, staying with them may make perfect sense. But now you're staying because you've compared your options, not because a renewal form showed up and signing it was easy. So when your mortgage comes up for renewal, remember these 5 things. Don't automatically accept the first offer. Negotiate with your existing lender and compare other lenders. Think carefully about fixed versus variable, based on your ability to handle changing rates. Look at what your remaining amortization is doing to both your monthly payment and your long-term interest costs. And start shopping around before your renewal date arrives. Your mortgage is probably one of the biggest financial commitments you'll ever have. Spending a little time negotiating it every few years could potentially save you thousands of dollars. Don't treat mortgage renewal like paperwork. Treat it like a financial decision.